Hello, and welcome to Atharv Gyan. Let's continue the topic, decentralized stablecoins, the future of stable value in DeFi. Now, over to Lisa and Monarch to take it forward.
Welcome to the deep dive. So we're diving into something, well, pretty central to crypto, right? This big paradox.
Yeah, exactly. You've got all this amazing innovation,
Right.
but then you have this just wild volatility. Bitcoin going up, down, all over the place.
It makes you wonder, how can you possibly build like stable financial stuff on top of that?
Yeah.
For everyday things.
It's a huge hurdle. I mean, nobody wants their paycheck or their savings bouncing around like that day to day.
Definitely not. And that brings us right to our topic, decentralized stablecoins.
And these aren't your standard digital dollars, not quite. They're a really fascinating attempt to create stable value without needing a central company holding the bag, so to speak.
Okay, so that's our mission for this deep dive then. We want to unpack how they actually work.
Yeah, the mechanics, the pros and cons, which are definitely there.
And see where they fit into DeFi, this whole decentralized finance world. Plus, what's happening with regulations, what's coming next.
And for everyone listening, we're basing this on a really comprehensive piece. Decentralized stablecoins, the future of stable value in DeFi. So this should get you up to speed pretty quickly.
All right, let's jump in. Where do we start? The basic problem.
Yeah, let's start there. The core issue stablecoins were invented to solve is that crazy price volatility we mentioned.
Right, like trying to buy your coffee with Bitcoin.
Exactly. Or imagine trying to take out a loan denominated in ETH. The value could swing massively, making it almost unusable for, well, normal financial activities.
So stablecoins are the answer. They're basically crypto designed to hold a steady value.
That's the idea. Usually pegged to something like the US dollar.
Okay.
But sometimes gold, or interestingly, even other crypto assets, so that gets complex.
And in DeFi, they're kind of essential, right?
Oh, absolutely crucial. They let you trade, lend, borrow, hedge risk, all without constantly worrying that the value of your core asset is going to plummet overnight. It lets you stay in the crypto ecosystem while managing risk.
Now, you mentioned different types. They're the ones most people have heard of, maybe, like Tether or USDC.
Right, those are the big ones. Fiat collateralized. A central company holds dollars in a bank account, supposedly one-to-one backing for each coin. Or like PAXG, backed by actual gold.
But there's a central point of failure there, or control.
Exactly. That's the key difference.
Right.
Decentralized stablecoins try to get rid of that central issuer.
How?
Well, they use different tricks. Either they rely on crypto assets locked up on the blockchain itself as collateral managed with code,
Okay.
or they use clever algorithms, again, run by smart contracts, to manage the supply and keep the price stable. That's where things get really interesting and sometimes a bit wild.
Let's dig into that first type then, the crypto collateralized ones. You called it an over-collateralized fortress. Sounds secure.
It aims to be. The basic idea is you lock up volatile crypto, like Ether or maybe wrapped Bitcoin, into a smart contract. Think of it as a vault. And against that collateral, you can mint the stablecoin. But here's the key. You have to put in more value in collateral than the value of the stablecoins you mint.
So over-collateralized. Like if I want $100 worth of the stablecoin, I need to lock up, say, $150 of ETH.
Exactly. Often it's ratios like 110%, 150%, sometimes even 200% or more, depending on the system and the collateral's volatility. It creates a buffer.
What happens if the value of my ETH drops, though, below that threshold?
That's the liquidation mechanism. It's a crucial safety net. If your collateral value falls too low, say below 110% of your debt, the smart contract allows anyone to trigger a liquidation.
Anyone.
Yep. They repay some of your stablecoin debt, and in return, they get a chunk of your collateral, usually at a slight discount as an incentive. The repaid stablecoins are typically burned.
So the system forces the debt to be covered before the collateral becomes insufficient.
Precisely. It's designed to keep the stablecoin fully backed, even if the collateral prices are falling. It protects the peg.
MakerDAO's DAI is the classic example here, right?
Absolutely. It's one of the oldest and most respected. With DAI, users lock up various approved tokens. It started with just ETH. Now it's multi-collateral DAI, so things like BA, WBTC, even some tokenized real-world assets.
And USDC too, I think, which raises questions.
It does. Adding centralized stablecoins like USDC as collateral definitely sparked debate about, re-centralization. How decentralized is it if it relies partly on centralized assets? It's a trade-off they made for stability and scale.
How is it governed? Who decides those collateral ratios and fees?
That's done by the holders of the maker token, MKR. They vote on all the critical risk parameters, liquidation ratios, stability fees, which assets can be used as collateral. It's all done through on-chain governance proposals.
Has it proven resilient? Like in a real crisis?
It has, most notably during Black Thursday in March 2020. Crypto markets crashed hard, ETH prices plummeted, and it put immense stress on the system.
What happened?
There were issues. Some liquidations didn't happen efficiently because the network was congested. But Maker DAO governance acted fast. They adjusted parameters, held debt auctions using MKR tokens to recapitalize, and ultimately safeguarded the peg. They even have an emergency shutdown mechanism as a last resort.
Wow. And DAI is pretty big now.
Yeah, market cap often exceeds $5 billion. And a key benefit is transparency. Because it's all on-chain, anyone can audit the health of the vaults, check the collateral levels in real time.
Okay, so the benefits are clear. On-chain backing, decentralized governance, transparency, censorship resistance.
Right.
But the drawbacks. You need a lot of crypto capital locked up. There's still liquidation risk if markets move really fast. And maybe it's complex for average users.
All true. That over-collateralization means capital inefficiency. And yes, understanding liquidation ratios and managing your vault requires a certain level of sophistication.
Okay, that crypto collateralized model makes sense. Robust, but capital intensive.
Yeah.
What's the other main path? The algorithmic one.
Right. Algorithmic stablecoins, these are kind of the code-driven balancing act. The core idea here is, well, different. They generally try to maintain the peg without direct collateral backing, or at least not full collateral backing.
Now, collateral, how on earth do they stay stable then?
Instead of collateral, they use algorithms encoded in smart contracts to dynamically change the token supply.
Okay. How does that work?
It's usually based on the price. If the stablecoin price goes above the target, say $1, the protocol's algorithm mints new tokens and distributes them, maybe to existing holders or through other mechanisms. Increased supply, price comes down.
And if it goes below $1?
The opposite. The algorithm initiates actions to reduce the supply, maybe by burning tokens during certain transactions or offering incentives to take tokens out of circulation. Less supply, price goes up. Theoretically.
Theoretically. Okay, what are some examples here?
Well, there was Ampleforth, AMPL. It uses a daily rebase. Your wallet balance literally changes every day. If AMPL is above target, you get more tokens. If below, you lose tokens. The goal isn't a strict $1 peg, but stable purchasing power over time. It's different.
Yeah, that sounds a bit mind-bending.
It can be. Then you had Frax, FRAX, which was really interesting because it pioneered a hybrid model.
Hybrid? How so?
It was partially backed by collateral, like USDC, and partially stabilized algorithmically using its governance token, FXS. The ratio between collateral and algorithmic backing, the collateral ratio or CR, wasn't fixed. It would adjust based on market demand for Frax.
So sometimes it's more collateralized, sometimes more algorithmic.
Exactly. It floated often around, say, 70–90% collateralized. But interestingly, in early 2023, the Frax community actually voted to phase out the algorithmic part completely and move to 100% collateralization.
Really? Why?
Probably a combination of things. Regulatory pressure, for sure, but also likely learning lessons from the big cautionary tale in this space.
Ah, you mean Terra USD or UST?
The very one. Its collapse was monumental.
We know about the crazy 20% yield on Anchor protocol that sucked people in. But what was wrong with the design itself? That LONA connection.
That was the critical flaw. The reflexivity. UST was algorithmically linked to LUNA. To get UST, you had to burn LONA. To redeem UST, if it fell below peg, the system would mint LUNA for you.
So they fed off each other.
In a potentially dangerous way. Anchor's high yield created huge demand for UST. People bought LUNA, burned it to mint UST, locking UST in Anchor. This burning reduced LUNA supply, driving its price up.
Which makes the whole thing look stronger.
Exactly. Higher LUNA price meant you could mint even more UST, creating this feedback loop. It looked like genius when prices were going up.
Until they weren't.
Precisely. When confidence wavered in May 2022, maybe triggered by large withdrawals or strategic selling, UST started to slip below $1. People rushed to redeem UST for LNA via the algorithm.
And the system started minting LNA like crazy.
Hyperminting. The supply of LNA exploded. Its price crashed from like $80 down to practically zero. UST completely depegged. The whole $60 billion ecosystem just evaporated in days.
Wow. The death spiral.
The classic death spiral. The lessons were brutal. The danger of relying on unsustainable yields in this kind of unchecked, algorithmic reflexivity. Plus, the subsequent fraud findings against Terraform Labs and Decon didn't help restore faith.
So looking at algorithmic stablecoins overall, the potential strengths are lower capital needs, maybe more flexible supply.
Yeah, potentially more capital efficient, more adaptive.
But the weaknesses are huge. Super sensitive to market trust, lose the peg, complex, hard for users to grasp, and obviously vulnerable to these catastrophic failures if the model breaks.
Absolutely. That trust element is key. Unlike over-collateralized coins where you can see the backing on-chain, with algos, you're trusting the code and the economic incentives will hold, even under extreme stress. And sometimes they just don't.
Which really highlights that even in these decentralized systems, the rules and how they're managed, how they're governed, are absolutely critical.
Couldn't agree more. And that leads us straight into governance and risk management. Because even if code is law, humans design the code, and often humans govern how it changes.
So how do these protocols adapt? Who decides to change the rules, like those MakerDAO collateral ratios?
It typically comes down to token-based voting. Holders of the protocol's governance token, like MKR for Maker or FXS for Frax, back when it had the algorithmic component, they vote on proposals.
Proposals for what, specifically?
Things like changing the stability fee on DAI, adjusting the collateral ratio for Frax, setting debt ceilings for how much of a certain collateral type can be used, approving new collateral types. It's all managed through formal processes like Maker Improvement Proposals, MIPs, or Frax Improvement Proposals, FIPs.
And these votes, if passed, they automatically update the smart contracts.
Often, yes. There might be a time lock for security, but the changes are executed on-chain based on the vote outcome. It's governance by code in a way.
You mentioned MakerDAO's emergency shutdown earlier. How important are those kinds of safety valves? Did Terra or Frax have something similar?
Hugely important. That MakerDAO shutdown capability, while centralized in a sense, provides a crucial backstop. Frax and Terra lacked such robust, quick-acting emergency brakes, which arguably made their crises worse. They couldn't just hit pause when things went sideways.
But this governance, is it truly decentralized? What if a few big players, like VCs or early investors, hold most of the voting tokens?
That's a massive ongoing debate. You absolutely see concerns about voting power concentration. We saw it in discussions around Maker's endgame plan and the distribution of MKR, or even that Frax FIT 188 vote while it passed overwhelmingly. You have to ask who holds the decisive votes. It challenges the whole notion of decentralized control.
Yeah, it's a tension. What about the data feeding into these systems, like the price of ETH for liquidations? How do they ensure that's accurate?
That's where price oracles come in. They're vital. Services like Chainlink provide price feeds for various assets. Crucially, they often use time-weighted average prices, or TDAPs.
TUAPs.
Yeah, time-weighted average price. Instead of just taking the current spot price, which could be easily manipulated in a flash crash or spike, they average the price over a set period. Makes it much harder to game the system and trigger unfair liquidations.
And governance can update these oracles too.
Yes, if a price feed is deemed unreliable, or if a better source becomes available, token holders can vote to switch or adjust the oracle configuration. Transparency and reliable data are non-negotiable for these systems to work.
Okay, so we've got the mechanics, the governance, but let's connect this back to the listener. Why should you actually care about decentralized stablecoins? What do they do in the real world, or at least the DeFi world?
Right, this is where it gets practical. They aren't just theoretical constructs. They are fundamental building blocks for a huge range of applications you might use in DeFi.
Like what? Lending?
Absolutely. Lending and borrowing protocols like a Have or Compound heavily rely on stablecoins. You can deposit your DAI or USDC, earn interest on it because others are borrowing it.
Okay.
Or you can use your volatile crypto, like ETH, as collateral to borrow stablecoins. This lets you get liquidity without selling your ETH, maybe for spending or leveraging up. Stablecoins provide that stable medium of exchange within these platforms.
Makes sense. What about trading, DXs?
Essential for automated market makers, AMMs, like Uniswap, Curve, or Balancer. Stablecoin pairs, like USDC DAI or USDT USDC, form some of the deepest liquidity pools.
Why is that?
Because trading stablecoin to stablecoin or stablecoin to volatile asset is extremely common. Deep stablecoin pools mean lower slippage, especially for big trades. And Curve, in particular, specializes in super efficient stablecoin swaps. They're also useful for liquidity providers to reduce impermanent loss compared to volatile pairs.
Got it. And yield farming, that term pops up a lot.
Yep. Yield farming and staking. Stablecoins are often the preferred asset here. Protocols like Yearn Finance act as yield aggregators. You deposit your stablecoins, and Yearn automatically moves them around different DeFi protocols, chasing the best interest rates or rewards and auto-compounding your earnings.
Trying to squeeze out the best APY.
Exactly. It automates complex strategies that would be hard for an individual to manage. Stablecoins make it easier because the base asset value isn't fluctuating wildly.
What else? Synthetics.
Yeah, synthetic assets and derivatives. It's pretty cool. Protocols like Synthetics use their own stablecoin, SUSD, as the core collateral. Users lock up SNX tokens, Synthetics' native token, to mint SUSD.
And then?
Then, using that SUSD within the synthetic system, you can create synthetic versions of real-world assets like SAPL for Apple stock, SXAU for gold, SER for euro. It allows on-chain exposure to these assets without needing traditional brokers.
Interesting. Are there more, like, day-to-day uses emerging?
Payments? Definitely. Cross-border payments and remittances. This is a big potential use case. Sending stablecoins across borders can be near instantaneous and much cheaper than traditional bank wires. Think about projects or integrations like Circle using USDC with Visa for merchant settlements globally.
Okay, that could be huge.
And we're seeing DAO, treasury management, and on-chain payroll. DAOs, these decentralized autonomous organizations, often hold their funds in stablecoins to avoid volatility affecting their operating budget.
Sorry.
And tools like Gnosis Safe allow multi-signature control over these treasuries. Plus, protocols like Superfluid enable streaming payments. Imagine getting your salary paid out second by second in stablecoins directly to your wallet.
That's pretty futuristic. What about managing risk?
That too. Risk management and insurance. There are DeFi insurance protocols where you can buy coverage against specific risks, like a smart contract getting hacked or a price oracle failing. You typically pay the premium in stablecoins, like DAI or USDC.
And if the covered event happens?
The claim is paid out, predictably, in stablecoins. It provides a way to hedge some of the unique risks within DeFi.
So they really are woven into the fabric of DeFi. Lending, trading, yield, synthetics, payments, treasury, insurance. It's everywhere.
Pretty much. They provide the stable foundation that allows all this other innovation to happen more reliably.
Okay, so given how important they are, what's the deal with regulation? It feels like that's heating up. We're looking at 2025 as a big year.
Absolutely. Regulators worldwide have woken up to stablecoins, especially after the UST collapse. The focus is really on things like AML KYC, sanctions compliance, and managing systemic risk if these things get really big.
What's happening in the U.S.?
Significant moves lately. There's the Genius Act. It actually passed the Senate in June 2025. Its goal is to set up a clear framework for payment stablecoins managed jointly by federal and state authorities.
What will it require?
Things like strict rules on reserves, what assets can back the stablecoin, how they must be held, regular audits, plus consumer protections like clear redemption rights. It's expected to move through the House, too.
Okay, one piece of the puzzle. What else?
There's also the FIT21 Act. The House approved this one back in May 2024. It's broader, trying to sort out which agency regulates which digital asset, CFTC for commodities, SEC for securities.
How does that affect stablecoins?
Crucially, it aims to define permitted payment stablecoins and exempt them from being regulated as both a commodity and a security, potentially simplifying things for issuers who meet the requirements.
So the U.S. is moving towards clearer rules, it sounds like. What about Europe?
Europe's arguably ahead with its micro-regulation markets in crypto assets. It became fully applicable right at the end of 2024.
And what does Micah say about stablecoins?
It's pretty comprehensive. Issuers of significant stablecoins, especially e-money tokens pegged to fiat, essentially have to register and operate like electronic money institutions, meaning strict requirements for 1.1 reserves held in safe liquid assets, capital buffers, operational resilience, and guaranteed redemption rights for holders. And significantly, MiCA effectively bans purely algorithmic stablecoins like UST was. Big statement there.
Wow, okay. So a much stricter regime in the EU. What about elsewhere? Asia?
Similar trends towards regulation. Singapore has its MAS framework focusing on disclosure, value stability, and capital. South Korea enacted the Virtual Asset User Protection Act, VAUPA, with reserve and custody rules. And Hong Kong is expected to pass its own stablecoin bill this year, likely focusing on licensing and reserves, too.
So the global direction is definitely towards more oversight, more guardrails.
Unquestionably. The Wild West days seem to be ending, at least for the major stablecoins that want to operate globally and integrate with traditional finance. We're even seeing talk about things like tokenized money market funds potentially competing in this space.
So, with regulation solidifying, what does the future look like? What kind of innovation is still happening?
Oh, plenty, especially around making DeFi work better across different blockchains. That's cross-chain DeFi and interoperability.
How so?
We're seeing advancements in zero-knowledge bridging. Bridges, historically, have been major targets for hacks. ZK proofs offer a way to verify transactions between chains without the same security risks. Some estimates say they could cut bridge exploits by over 60%.
That would be huge.
And there's the rise of intent-based execution and AI agents. Imagine just stating your goal: I want to swap USDC on Ethereum for SOL on Solana with the best possible rate. And an AI agent figures out the optimal path, maybe routing through multiple chains or protocols, and executes it for you.
Taking the complexity out of cross-chain stuff.
Exactly. We might also see hybrid monetary ecosystems. Think private stablecoins, maybe issued by banks or fintechs, but potentially backed by reserves held directly at the central bank. Some research suggests this could blend the innovation of private stablecoins with the trust anchor of central bank money, maybe preventing bank-run style DPEGs.
Interesting. Are central banks themselves experimenting?
Yes, with CBDCs and bank token trials. Project Acacia in Australia, for instance, tested a wholesale CBDC, exploring how tokenized central bank money and commercial bank money could improve things like collateral management in financial markets. It shows traditional players are actively exploring this tech.
What about the stablecoin designs themselves? Anything new there?
Definitely. We're seeing novel protocol designs emerge, things like universal payment channels, maybe hub and spoke models to make transfers across different chains seamless, and more advanced hybrid stabilization protocols.
Hybrid how? Combining different methods.
Yeah, maybe combining the best of different worlds. Crypto collateralization for a strong base, maybe some algorithmic elements or futures contracts for elasticity, AI-driven arbitrage bots maintaining the peg, and even using ZK proofs for privacy-preserving AML compliance, trying to balance stability, decentralization, and regulatory needs.
A complex balancing act.
It is. And finally, look out for AI and DePIN synergies.
DePIN.